Curious. Imagine a tiny Shiba standing next to a balloon labeled AI. At first, the balloon is small. It helps people write emails, summarize documents, make images, write code, and answer questions. Real uses, real excitement. Then investors arrive with giant money pumps. One pump says chips, one says data centers, one says cloud contracts, one says startups, one says electricity. The balloon grows bigger and bigger.
Here's the strange part. The balloon can be filled with real air and still become overinflated. That is the AI bubble debate. People often argue about AI in two extreme ways. One side says AI will transform the whole economy. The other side says the whole thing is hype. But economics gives us a more useful question. Can a technology be real, useful, and important while investors still pay too much, build too fast, and expect profits too soon? Yes. That is how many bubbles work. In this video, we will explain what a bubble actually is, why AI looks bubble-shaped to some investors, what data centers and electricity have to do with it, and what signs matter more than dramatic headlines. No stock tips, no crash prediction. Let me break this down. A financial bubble is not the same thing as a fake technology. A bubble happens when expectations, prices, and investment plans rise faster than realistic future cash flows can support. Think of a lemonade stand. If the stand sells 10 cups a day, maybe it is worth a small amount. If customers love it and sales grow, it can be worth more. But now imagine everyone believes this lemonade stand will soon sell lemonade to the entire planet. Investors start funding lemon farms, giant juicing machines, delivery trucks, neon signs, and a global lemon headquarters. The stand may be real. The lemonade may be delicious. But if the world does not buy enough lemonade quickly enough, the investment was too far ahead of the business. Curious. That is the key idea. Bubbles often grow around real stories. Railroads were real. The internet was real. Smartphones were real. Some companies became enormous. Many investments still failed because the timing, price, debt, or expectations were wrong. So the question is not, is AI useful? The better question is, can AI generate enough cash soon enough to justify the amount of money being spent around it? To understand the AI bubble debate, picture an AI factory. At the front door, users ask for code, research, images, customer support, legal drafts, product designs, and video ideas. Behind the door is a huge chain. There are advanced chips, there are servers, there are cooling systems, there are data centers, there are power lines, there are cloud contracts, there are engineers, there are investors expecting returns. AI may feel weightless on your screen, but the business behind it is heavy. The International Energy Agency reported that the largest technology companies spent more than $400 billion in capital expenditure in 2025, and that spending is expected to rise another 75% in 2026. Capital expenditure means money spent on long-lived assets, buildings, servers, chips, power equipment, and other infrastructure. That is not a tiny experiment. That is a massive physical build-out. The same IEA report said global data center electricity demand grew 17% in 2025, while AI-focused data center electricity consumption grew 50%. It also projects data center electricity consumption rising from about 485 terawatt-hours in 2025 to about 950 terawatt-hours in 2030. These numbers do not prove a bubble by themselves. They prove something else. The AI boom is not only software. It is concrete, copper, chips, cooling, land, power, and financing. That makes the economics more serious. Before we get skeptical, we should be fair. There are good reasons companies are spending so much. AI models need computing power. Customers want faster tools. Cloud providers compete to offer capacity. Firms that fall behind may lose future markets. If AI becomes a general-purpose technology, like electricity or the internet, then early infrastructure could become extremely valuable. In that world, today's spending is not waste. It is a race to build the roads before the city arrives. Curious. Imagine a town where everyone suddenly wants delivery drones. The first company to build landing pads, charging stations, software, and warehouses might dominate the new economy. Waiting too long could be expensive. That is the bull case for AI spending. Build now, capture demand later. Now comes the risk. The cost arrives before the proof. A data center must be financed, built, powered, cooled, and filled with expensive equipment before enough customers have paid enough money to justify it. If demand grows as expected, this works. If demand is slower, cheaper, less profitable, or more competitive than expected, the math gets uncomfortable. This is why people focus on return on investment. AI can save time, but saving time does not automatically become profit. A company must integrate the tool, change workflows, train workers, protect data, avoid errors, and measure results. MIT Nanda report summaries have widely cited a sharp warning. Many enterprise generative AI pilots showed no measurable profit and loss impact. The useful lesson is not that AI has no value. The lesson is that business value is harder than a demo. A chatbot that impresses a manager for 10 minutes is different from a system that changes a company's costs, revenue, and margins for years. Here is the simplest way to see the whole debate. On one side of a canyon, companies are spending money now. On the other side, they hope for future cash flows, subscription revenue, cloud usage, productivity gains, automation savings, and new products. Between the two sides is a bridge. If the bridge is strong, the boom can become a durable industry. If the bridge is weak, spending may fall, valuations may reset, and some projects may become stranded assets. Curious. A stranded asset is something expensive that was built for a future that did not arrive on schedule. It could be unused server capacity. It could be a delayed data center. It could be a startup that needed cheap money to survive. It could be a contract that made sense only if demand kept rising. Again, this does not mean all AI fails. It means the winners may not be the same as the companies, projects, or investors that looked strongest during the build-out. So what signs make people worry about a bubble? First, concentration. If market gains depend heavily on a small group of companies, the whole story becomes sensitive to their earnings, spending plans, and guidance. Second, circular demand. This happens when money moves among connected players in ways that can make demand look stronger than independent customer demand. For example, if one company invests in another company that then buys the first company's products or cloud services, the revenue may be real, but analysts will ask how independent and sustainable that demand is. Third, financing pressure. Data centers are expensive. If companies need more debt, outside capital, or long-term contracts to keep building, the boom becomes more sensitive to interest rates and investor confidence. Fourth, bottlenecks. Power, grid connections, transformers, chips, cooling systems, land, and permitting can slow the physical world down. Software can scale fast. Electricity infrastructure usually cannot. Fifth, weak payback. If customers love trying AI but do not pay enough for it, or if competition pushes prices down, then usage can grow while profits disappoint. If an AI bubble deflates, it does not have to look like one dramatic pop. It could look like delayed projects, smaller data center plans, lower startup valuations, slower hiring, cheaper cloud prices, investors asking for profits instead of promises. Some companies could survive and become stronger. Others could disappear. Infrastructure could be sold, repurposed, or written down. This is what happened after earlier technology booms. The internet did not vanish after the dot-com crash, but many internet companies did. The surviving technology changed the world. The overextended investments still hurt. That distinction matters. If someone says AI is a bubble, they might mean AI is useless. That is too broad. They might mean AI-related asset prices are too high. That is a different claim. They might mean infrastructure is being overbuilt. Another claim. They might mean enterprise adoption is slower than expected. Another claim. Good economics separates these claims instead of mixing them into one dramatic sentence. So, is AI a bubble? The honest answer is, parts of the AI boom can be bubble-shaped without the entire technology being fake. AI has real uses. AI infrastructure is real. Productivity gains may be real in some areas, but the investment story also depends on very large future profits arriving fast enough to justify very large spending today. Think of the balloon again. Air is real. The balloon is real. The party may be real. But if the pumps keep running faster than the balloon can safely hold, pressure builds. The next time you hear AI bubble, ask 3 questions. First, what cash flow is supposed to pay for the spending? Second, how long will it take for customers to adopt the technology at scale? Third, who is left holding the cost if expectations reset? That is the economic story behind the AI bubble debate. It is not a simple story of genius or hype. It is a race between real technology, physical infrastructure, investor expectations, and future profits. Curious. And in that race, the most important question is not whether the balloon can fly. It is whether it has been inflated faster than the basket underneath can carry. If this helped you understand the AI bubble debate, subscribe to Shiba Economics for more clear explanations of how money, markets, and the economy actually work.